A very warm welcome to all our viewers to the 18th edition of Cedrus Knowledge Series, an initiative wherein we have one speaker each month speaking on a variety of topics ranging right from investing to well-being. We will now play a short video of Cedrus Wealth Partners. For our 18th edition, we are extremely honored to have Mr. Shobhit Mehrotra, Head Credit and Senior Fund Manager, Fixed Income, HDFC Asset Management, as our esteemed guest. We will now play a brief video to further introduce him. We look forward to having an insightful session with Mr. Mehrotra. Once again, a very warm welcome to all our viewers and our speaker. I would now like to hand over to Mr. Nilesh Bajaj for taking the session ahead.
Hello, everyone, and thank you, Shobhit, and taking time out, during a off day. It's indeed, thank you very much for being a part of the Cedrus Knowledge Series 18. Uh, this is the 18th edition of Knowledge Series, so it's been 1.5 years, and our core intention is to provide first-hand knowledge to the viewers. Um uh, what we will do is Shobit, I'll just take you through. This is a moderated session. We will have a set of our questions which we'll ask you and viewers for your benefit. In case if you have any questions, you can just type it in the mailbox, and we will take it at the end of the session. Uh, so, Shobit, should we begin?
Yeah, I'm ready.
Yeah. So, Shobit, indeed, it's been equity markets are not doing well, but, in fact, last year, after a very long time, we have seen, in fact, debt markets really doing very badly, in fact. And, we have seen, debt funds, in fact, giving minuscule returns to investors uh, because of the yields rising, in fact. So, my first question to you, Shobit, is, you know, last year has been a lackluster year for debt funds with rising bond yields. Uh, FY22 has also started with a lot of action in the bond markets with two back-to-back announcements. First, the introduction of the STF in April 2022 policy, and then an off-cycle rate cut which happened in May 2022, which was not expected. It was not something which the indication was given by RBI, in fact. Uh, will this year also be a muted year, or citing that the bond yields have already risen in anticipation of rate hikes? Would the this year not be as bad as last year? So, could you give some brief on how do you expect this year to be for debt funds?
Yeah, thanks, Nilesh. I think the current year will be a year of two halves. Basically, first half is going to be difficult. You know, uh, first 6 months, first few months, in fact, of the fiscal year have started on a difficult note, as you said, off cycle rate hike, other steps by RBI, CRR hike. So the first half, we expect things to continue to remain difficult, but I think the situation will significantly stabilize in the second half. When I say Second half, basically, by September, we will get to know the kind of rate hikes which RBI is likely to do in the remaining part of the year. We will get to see how aggressive the US Fed is going to be. The expectation is that after doing 150 basis points hike by the US Fed, they will do two more hikes of 50 basis points and then may take a pause in September and thereafter look at maybe hiking 25 basis points each. So the situation in the first half, yes, will continue to be difficult as we have already seen. But the second half, my sense is the situation is going to stabilize quite a bit. In India, the RBI is likely to take the repo rate to pre-COVID level. Pre-COVID repo rate was 515. So we are today at 440. The probability of going to 515 by end August is almost a given. Thereafter, the market is now pricing in a scenario that repo rate may be somewhere around 6 half, and that too by December. So market has gone from one extreme to another. It is pricing in a lot of bad news. So even with now rate hikes happening, the yields may not rise as much. So first half, we've already seen 100 basis points move on the yields. Even with just 40 basis points of rate hike, the yield movement has been 100 basis points. So market is, because markets are forward looking, even the future rate hikes have been kind of priced in already. So
Right.
as the scenario unfolds in the second half and as the market gets to see that the trajectory of rate hikes by RBI is not going to be so aggressive, it will be a little bit more gradual, then I think the yields would stabilize and the situation will improve significantly. So overall for this year, my sense is, given the kind of yield movement which we have already seen, further hit is going to be there, but it will be limited and it may get all happen in the first half. Second half situation will stabilize, and for the year, for the full year, the return will still turn out far better than last year. So my sense is that yes, the volatility of first half needs to be looked through. Investors need not panic in the next 2-3 months as the rate hike cycle is just starting out. When we are into the rate hike cycle, the situation is going to stabilize. Second half onwards, situation will look far better and returns also will be significantly better than last year.
And this actually gives a lot of confidence because this is something which we have been reiterating to our investors also. And, with an expert coming up with the same opinion that, the rate hike was already partly discounted, not completely. This year may not be as bad as what we have seen with the 100 basis point yield increase, which we have seen last year, in fact. One more question I wanted to ask is, so, with this expected rate hikes, we have already seen one rate hike. Which, part of the yield curve, okay, the shorter end, medium end, or the longer end, is where the pain will be, in fact.
So, given the short to medium segment duration is relatively lower,
Hmm.
the hit of rising yields is also going to be lesser.
Right.
Uh, the longer duration, longer end of the curve, whether it is long term, long duration funds, gilt funds, they will still see some more pain. the view is that 10-year yields can go as high as 7.75 or even 8%, some people expect in the market. So 7.5 to 8 on the 10-year bond yield is a good buy zone.
Mm-hmm.
That is the time when yields hit 7.5 and above. That is the time to start adding little bit more duration on the portfolio. Now, whether
Mm-hmm.
you do it through short to medium bond funds or you gilt funds or long duration products like dynamic or income, uh, that is up to the investor to decide. But the point is that on the overall portfolio, investors need to add duration as yields go. That the 10-year goes from 750 to 770 to even say 8%. So that would be the time to really take advantage of the higher yields, get invested, with little bit more duration on the portfolio.
Okay. No, in fact, we have seen a CRR hike of 50 basis point also. In fact,
Yeah.
now, could you throw some light on how does it affect the liquidity and the shorter end of the curve, actually, the yield movement of the shorter end of the curve?
Yeah, so see, because of the various steps which RBI has taken, they first introduced SDF, the standing deposit facility, then they, hiked the rates, and then they hiked the CRR also. CRR has taken away some 87,000 crores of liquidity from the system.
Hmm.
Rate hikes and expected rate hikes in the future, all that has led to 100 basis points of movement, whether it is on the T-bills, whether it is on
Hmm.
CPCDs or shorter end yields. So 100 basis points of move is not a small move, it is a big
Hmm.
move which has already happened, pricing in 40 of hikes which are already done, and maybe 50-60 basis points of future rate hikes are also priced in. So a lot is already there in the price which we are seeing today. As further rate hikes happen, it is not necessary that there is yield movement of 1 to 1 on the rate hikes. So even if repo rate goes from 440 today to say 6%, which is 160 basis points of further repo rate hike,
Hmm.
may involve only 50 basis points of yield movement. Therefore, 50 basis point yield movement on a short to medium category may not result in a very large amount of hit. And even after taking that for the hit, the return which the investor would realize at the end of a year would still be quite decent.
Hmm. One more question, Shobit, is it's been 20 years in this industry, and we have always been recommended investors to park their liquid surplus in liquid funds, overnight funds, and then you have a lot of category with the SEBI categorization. You have quite a few funds with different maturity profiles in the liquid to shorter end of the curve. Actually,
Yeah.
that maturity profile, we have seen returns which have actually come down substantially, in fact. So in fact, we at Cedrus have been recommending investors who are individuals to not park money if they have for 1 or 2 months in overnight funds or liquid funds, because I'm sure the bank saving bank account also gives them about 3% return. Now that's what we have seen I think this has been for the first time after where the returns have been so low. So my next question to you will be regarding that with this yield moving higher, which space in the liquid uh, investment this thing will be a better option for investors to park their money, or will overnight only be a good option for them?
So clearly, if the investment horizon, it all depends on the investment horizon, right? If the uh, investor needs the money within 1 month, or 30 days to 45 days, then yes, overnight and liquid makes sense. Up to 1.5 months, clearly liquid and overnight continue to remain recommended products for that short period. But as the investment horizon goes from, say, 2 months to three, or up to even 6 months, then the other products come into play, like ultra short fund, money market, low duration, and floating rate. So these are four products which are all, between, say, 6 months to 1 year kind of average
Hmm.
maturity. And I think ultra short, money market, low duration, and floater, any of these products will can be considered from 6 months to 12 month investment horizon, and all of
Hmm.
them will give you very similar returns. So it's
Right.
I would say up to 1.5 months, stay in liquid overnight. If you have money for 3 months plus to a year, then look at ultra short, money market, or low duration and floater. So I think that bucket of four products can be considered for around a year investment horizon.
Okay. So we stick to liquid and overnight for extreme short-term liquidity
Exactly.
needs.
Yeah, absolutely.
Uh, our next question is, with high global inflation, uh, we have seen interest rates hike across central bankers across the world. In fact, we have seen rate hikes in India also. In fact, and RBI is targeting inflation, and that's the reason why they would increase rates. They have already had one rate hike. We may see some more in the future, in fact. But what we see is that this is more supply led. The inflation which we are seeing is more supply led, and it's not demand driven, which means the demand all of a sudden has not increased. And this is what we want some clarity on, that if it is supply led, do you feel the central bankers increasing rates will be detrimental to growth, or rate hike is something which is unavoidable, in fact?
So you're very right that this bout of inflation globally is a lot of it is supply driven. Uh, but uh, even when inflation is supply driven, the fear of central bankers is that it doesn't take too long for it to become generalized, wherein it gets entrenched in wage expectations, it gets entrenched as high inflation expectations, and that second round effects are far more difficult for central banks to handle, because
Hmm.
if wage pressures start coming in, then you start getting into a price wage spiral, as they say. So further, if the wages go up, further prices will go up, and then inflation keeps going higher and higher. So that is what I think most central bankers world over are afraid of, that they do not want this supply led inflation to become generalized, to have these second round effects, and therefore not lead to a vicious price wage spiral, which they want to avoid.
Hmm.
The only difference is that in the US, the there is a very high component also of demand-led inflation, which is very much unlike India. So in
Hmm.
US, if you see, the economy is doing very well. The
Hmm.
unemployment rate is one of the lowest.
Hmm.
So there is a very high probability that because of such low unemployment, there is pressure on wages. If
Hmm.
wages, it starts feeding into wages and other product prices, then it can get out of hand. So that is
Hmm.
what is the difference. In India, the
Hmm.
conditions are not as good as in the US. Our inflation is, lot of it is imported because of
Hmm.
high crude prices, high edible oil prices, which we import, high commodity prices. So our economy is not on such a strong footing that
Hmm.
it is leading to, or some high amount of inflation. Our
Hmm.
economy is in what we call a K-shaped recovery. Some
Hmm.
sectors are doing well. The
Hmm.
MSMEs and the SME sector is still not out of the woods
Hmm.
post-COVID. A lot of sectors are still hurting. Therefore, in India, RBI does not have too much of a room to go and continuously keep hiking rates.
Hmm.
Already, whatever hikes they will do will have some impact on growth. It is not as if that interest rates do not have any impact on growth. Incremental growth is likely to suffer,
Hmm.
maybe a little less, but there is going to be some impact on growth, especially in the US, with Fed hiking so much or Fed action being so aggressive,
Hmm.
they want to, cool down the economy. In
Hmm.
India, I think the RBI does not have much of a choice. Uh, because of all the rate hikes, there will be some degree of slowdown, which I think they will at some stage uh, feel that now enough hikes are done and they will have to stop any further hikes. So my sense is that second half of the year, therefore, will we'll get to see that yes, the slowdown is getting worse for us, and therefore RBI may have to go slow on any further hikes.
Yeah, in fact, thank you, Shobhit, for answering questions on inflation, future yield expectations, and the stance of RBI and other central bankers. We would definitely we have much more clarity on how do we actually approach the fixed income space, the debt fund space. Now, coming to our next question, in fact, is this is to do with the passive debt funds. I think it all started with the Edelweiss Bharat Bond ETF a
Yes.
long time back. We have seen a plethora of SDL portfolios, which 26, 27, and we have seen those kind of ETFs which have been launched. In fact, do you feel that this is the way forward? And second thing is, if someone who has a time horizon which matches with the with the maturity, it makes sense investing in these kind of instruments, in fact, and is this the way forward?
So, to tell you very frankly, personally, I'm not a big fan of buying these kind of products, especially when you are in the early stages of a rate hiking cycle, right?
Hmm.
Perhaps at a peak of the rate cycle, if somebody wants to set aside some money, it would
Hmm.
make sense. But any investment which has been done last 3 6 months back in these kind of funds is going to is suffering from the same MTM risk, right?
Right.
If you have a very similar investment horizon, say as a 2026 targeted
Hmm.
maturity product or a ETF or any such thing, then
Hmm.
with that kind of an investment horizon, open-ended fund is likely to outperform,
Hmm.
these kind of products, because what we have seen is the flexibility which they have, because
Hmm.
of a particular point on the yield curve which they are only investing in,
Hmm.
introduces a lot of inefficiency. So
Hmm.
typically, what happens if you are buying SDLs, you end up buying SDLs at a very low spread over the GSEC, or
Hmm.
you end up buying corporate bonds or AAA PSU bonds at almost zero spread to GSEC. So because the fund manager has no other option, they have to buy that particular maturity point only. And if they get large sums of money, their
Hmm.
hands are tied. They, if the availability of the asset in the market is not there, you end up, investing in a suboptimal manner. The yields are not that good. So if you
Hmm.
remain in a open-ended product, I think the
Hmm.
flexibility which the fund manager has, they will, of course, a fund manager will look all segments of the yield curve and invest where you are getting the maximum risk reward in your favor. So if the spreads are looking attractive, if that the roll down benefit is good, So all that, and the fine tuning of duration as time goes by, that
Hmm.
maybe this cycle, rate hiking cycle, may continue just for maybe a year or less than that. So at what point do you really want to increase your duration, and what point do you start want to keep booking your profits and cutting down and things like that? I think it's just not possible. The only charm, I think, which investors are probably going after is that mark to market is kind of not seen on a day to day basis, because this is
Hmm.
considered as my long term investment.
Hmm.
People tend to ignore the MTM
Hmm.
impact, but it is very much there. I mean,
Right.
all the investments which anybody would have done in the last 3 6 months have the same
Hmm.
MTM hit which open-ended funds would have taken. So it doesn't
Hmm.
really, you can't wish it away,
Hmm.
but that is very much there. So might as well
Hmm.
be in a open-ended fund and have the flexibility of investing across the yield curve.
Yeah, because I think what you mentioned. Because we are expecting the rates to peak out somewhere in
Yeah.
the future. That's the reason why we actually asked you this question, because there are these funds which are actually may benefit in case people are looking at high yield papers which are in fact hold on to these funds. But very, very true. We have seen negative returns in these funds in the last 6 months. They have fallen much more than a lot of open-ended debt funds. Uh,
Yeah.
uh, you know, One more question related to another product actually. So this was on the ETF actually, and now I come to last year was it was a bad year for the debt funds. Uh, Returns were extremely low, and I think the credit spaces which actually I think gave some 4-5% return, whereas most of the other funds actually struggled, and that was to do with the way the yield movement happened. In fact, uh, now there are investors who have invested in funds which are hybrid funds, hybrid debt funds with 15% equity exposure. Okay, and seriously, it's not like it's a pure debt fund. So you have funds which are hybrid and have 30% equity exposure also. In fact, the equity markets did well last year. We have seen equity markets have fallen this year. Do you feel that this is a right strategy where investors actually are going and investing in funds which have a mix of debt and equity, even though equity is in a minority component, uh, instead of putting money into a pure fixed income instrument just because the rates were the returns were lower?
I think is a entry level exposure to having some equity,
Hmm.
component in the portfolio. At times,
Hmm.
what we've seen is investors have the asset
Hmm.
allocation which they have done on their total portfolio is
Hmm.
skewed at times more towards debt. Earlier there was a lot of
Hmm.
preference for fixed deposits,
Hmm.
bank fixed deposits, PPF, a lot of exposure to debt, while exposure to equity was relatively less. Now
Hmm.
this has been changing. I think we've
Hmm.
all seen how the SIP culture has come about. The
Hmm.
inflows and equity funds have improved significantly. But I think
Hmm.
somebody who is still focused on safety of debt, or
Hmm.
largely a debt-oriented investor, what if he wants to get some component of equity? Then entry-level product is a hybrid debt fund. Because
Hmm.
of the limited exposure to equity.
Hmm.
So my sense is that yes, if equity markets as they have corrected from the peak, uh, so it may be a good time that after a number of years we have seen that both equity and debt in the beginning of this year have underperformed, right?
True.
Equity has also
True.
fallen, debt has also fallen.
Yeah.
So from that perspective, if somebody takes a 3-year view,
Hmm.
because it has equity in it, and from for fixed income also, from tax point of
Hmm.
view, having a 3 year investment horizon makes sense, because then you qualify for long term capital gains. I think a
Hmm.
3 year investment horizon for these kind of products with some equity in it will definitely make sense, and
Hmm.
also give you
Hmm.
some exposure to equities, which is a growth story, and with India's growth path for the next 2 3 years looking good, hopefully equities also will contribute significantly positive returns. So overall return, I think, if our investor can be improved, by investing in these products, especially now. I think that both equity and debt have corrected. Nilesh?
Uh, right, sir. So moving to our next question,
Yeah.
earlier investors would invest in FDs for better tax efficiency. But now it seems that only the advantage of investing in in FDs is tax efficiency. Do you feel the days of better debt fund returns are history, and investors should invest in debt funds only for tax efficiency?
No, I don't think so. I think debt funds will do quite well. As I said, next 3 months are going to be difficult. Next 3 to 6 months is when we expect higher degree of volatility. We expect yields to kind of peak out, and that is the time to take advantage of investing in debt and then holding it for 3 years. So if you if one enters in the next 3 6 months, I think the total return which investor would get will be not just because of pure tax benefits, but even otherwise, the returns would still be quite good.
Yeah. Thank you. In fact, there was some range issue, network issue. Thank you, Unnati, for actually, taking over. Uh, the problem, this question, in fact, is something which, I had one more angle to it, is, this recategorization which has happened in, a
Mhm.
lot of these debt funds. Okay. Do you feel that is one of the reasons also why, the expectation of returns from debt funds should be tapered by investor? Because now, a credit risk fund cannot invest more than 10% in unlisted papers, and you have various rules which have come on the recategorization, after the recategorization which happened. So do you feel the expectation, which earlier used to be that, you do invest in debt funds for better returns than FDs as well as tax efficiency, the return should be muted also, because of that also?
So see, some of the changes definitely have a cost element attached to it, right? There is one requirement now that all debt funds have to keep 10% in government securities or cash
Hmm.
at all points
Hmm.
of time. So this was not there earlier. That again
Hmm.
leads to lower yield, because GSEC gives you the lowest yield, right? So if you invest in
Hmm.
GSEC, you get mark to market. If you keep in cash, you get low return. So GSEC and cash, 10% in each fund is
Hmm.
a lot. So that is eating into return. But
Hmm.
even then, I think yes, some of the changes which have been brought about have
Hmm.
made the fund industry, the fund management, and fund running these funds far more robust. So from that
Hmm.
point of view, from safety point of view, from liquidity point of view, from better management point of view, it is positive. But
Hmm.
because nothing comes for free,
Hmm.
everything, there's no such thing as a free lunch, as they say, right? So
Right.
if these changes have been brought in, they have
Hmm.
a cost. They are going to eat a little bit into returns. but
Hmm.
I don't think that is going to be a massive impact on returns. So in a good year, if we see yield movement of 50 100 basis points on yields moving down, I'm sure a lot of these costs will not appear that negative, and total returns would still be fairly attractive from comparing it to other instruments like fixed deposits.
Hmm. Thank you. In fact, my next question is, we are actually recommending three of the investments which you are funds which you are managing. The HDFC floating rate fund, medium term fund, as well as the credit risk fund.
Yeah.
Uh, so, uh, how are you positioning these funds with the current scenario of high interest rates and higher yields? In fact, so how have you positioned these funds? If you could elaborate
So
on the same.
yeah, so I'll start first with the credit fund. Credit fund, I think we are going still quite overweight on triple A.
Hmm.
There is still the supply of non triple A credits or non triple A bonds is still not as good. The spreads have narrowed on double A papers. Therefore, the
Hmm.
our view is that at some stage in the next 6 12 months, as the capex cycle improves, as the investment cycle in the economy improves, we'll get to see more of good quality double A names, and that is when we will shift more from triple A to doing double A's and maybe get far better spreads. But the overall portfolio yield, I think couple of months back we were say around six half 660. Today we are at 780. So we've
Hmm.
seen a very good jump in the portfolio yield on the credit fund, with yields going above 780 on the portfolio yield, with a fairly good mix of AAA and not very high component of single A or double A. So the portfolio is very strong, robust. I think post FT event in 2020 has been a very good exercise for the entire industry
Hmm.
to manage these products. We have been tested to the limit, because we saw our fund size go from almost down to half. From 14,000 crore, we went to all the way down to 6,000 crore. So now from
Right.
6,000 crore, we are back to 9,000 crore. I
Hmm.
think to my mind, it's a great product to invest some of your allocation for investors, maybe 20%, 30%.
Hmm.
The difference between a AAA fund versus a credit fund is still pretty decent. AAA products would be today somewhere around six half on the
Hmm.
portfolio yield. So again, six half, you're getting 780
Hmm.
with not a portfolio which is not adding significantly to the overall risk. So
Hmm.
on a risk adjusted basis, it looks pretty decent, with this kind of portfolio yields. Medium term also, I think the sharp move up on yields is pretty good. The overall duration here, we have to keep Macaulay duration between 3 and 4. We are
Hmm.
right now right at the edge on the 3 mark. As
Hmm.
yields go higher, we will take our duration also a little longer than, so we may come around in between 3 and 4 to 3.5 or thereabouts. So even that is a very good fund, because the portfolio yield here is again over 7.5, again
Hmm.
offering 100 basis higher than a 100% AAA corporate bond
Hmm.
fund.
Hmm.
So, and the last fund, I think floating rate fund, especially in this environment when yields are rising,
Hmm.
slowly more and more securities, the coupons are getting reset at higher levels. As
Right.
the next 3 6 months, we see more and more coupons get reset to post the rate hikes. Portfolio yield here also will improve even more. So we've come here
Hmm.
from 5.5 to 620. My sense is, we will improve even more. So there also, I think for a product which is just under 1 year on duration, there is not too much interest rate risk, and in an environment of rising rates, I think this is one fund which will do well, but over a 6 to 1 month holding period.
Mhm. No, in fact, that gives us a lot of clarity, in fact, as to how we can expect these funds to perform and how they are going to be managed. In fact, I would like to mention one thing is that, you spoke about HDFC Credit Risk Fund. You saw huge outflow into
So moving to our next question, what would be the fair return expectation what an investor should have for the next 3 years while investing in the current debt funds in the current scenario?
So if I uh, look at what the 3 year, say a triple A yield is today, uh, a triple A yield is around 7 quarter uh, on what you can earn on a triple A investment. If because of all the rate hikes, our view is that uh, yields may go higher by say 50 basis points in the course of the next 1 year. Now, 50 basis points on a 3 year paper would mean somewhere around, say, maybe 1.5% of return may get taken away by the mark to market impact. Even then, 7 quarter minus 1.25 or one half will still give you close to 6% kind of return on a 3 year investment of AAA 7 quarter kind of yield. So it is still a decent return, because my sense is on a fixed deposit or any other product, uh, uh, earning that kind of return becomes fairly difficult. The FD rates still haven't moved up, but here, even in a scenario where you take a 50 basis points impact, even then the returns are pretty good. And if someone stays put for the full 3 year, then of course you're earning almost a 7 quarter minus whatever could be the expenses. So that makes the return almost closer to 7%. So it's at this point of cycle, at this stage when yields have moved 100 basis higher and next 3 6 months likely to go even higher, if people invest in the next 3 6 months, I think the return, total realized return, will be fairly good. Anywhere from 6 to 7%, which to my mind is fairly decent.
Okay. I'm extremely sorry. uh, our last question actually is, advice to our debt investors. Because we do strategically invest in debt funds. It's not tactical allocation. So we
Right. So, continuing from Sir, uh, uh, we have been following and doing a strategic allocation to all our investors. Uh, what would your view and what would your advice be to all the investors who are looking to invest in the debt market in these current scenarios?
The- you this is to me, right?
Yes, sir.
Yeah. So I think, let me give a very simple analogy of cricket, right? We all have the IPL final tomorrow, but if I have to give you a analogy of cricket, so right now the, the pitch on which we are playing is offering a lot of bounce. Okay, the ball is seaming, the conditions are overcast, you know. So at this stage, it makes, the kind of batting you have to do is very defensive. You have to take only singles, right? You have to wait for conditions to improve, the pitch to start playing well, the overcast conditions to become sunny, and then when the pitch starts playing easier, then go for your big strokes. So right now, I think next 2 3 months, the the wicket is going to be bouncy, ball is going to seam around. Overcast conditions are there. Play defensive, take your singles, invest slowly. Investing in your singles, and then as situation improves, as it gets sunny, pitch starts playing easier, then go for whole hog investing. So next 3 months are 3 to 6 months are difficult. One need not get worked up on the all the volatility and the ball bouncing around. Play defensive, play with the straight bat, take your singles, and then wait for the conditions to improve, and then start taking your bigger strokes. So that is what broadly would be my advice for investors in the next maybe uh, 3 6 months. Yeah.
Thank you very much, actually, Shobhit. I'm sure, last 1 year has been a struggle for debt investors. We have been hounded with, with questions related to, what is the future expectation with a very muted year. And I'm sure, they were appropriate questions because of the way the funds have performed because of the higher yield, which we have seen, the yield movement. Uh, I'll just pass it on to Unnati if there are any questions from the audience. Uh, Unnati?
Yes, sir. That was an extremely insightful session, sir. Your views on the current RBI stance and the elaboration on the interest rate hike, the rising bond yields, and the view of the rising inflation has given our investors a detailed insight on the fixed income scenario in India and a perspective on the current macroeconomic parameters which is driving the current debt markets. Moving to the audience Q&A. My first question to you is, we've seen that the overseas fundraising through the external commercial borrowings, ECBs, by corporations in India has been increasing as compared to last financial year on account of the monetary policy tightening and the steady depreciation of the rupee. However, with the global interest rate hikes poised to edge up and the relative attractiveness of the ECB inflows may diminish, what are your views on this and how will this impact the Indian capital markets?
See, as long as liquidity in the banking system is good, if the corporates are unable to borrow overseas, that borrowing will get shifted into the local market. So this we have seen, keeps happening very frequently. In the past, we've seen this happen on several occasions that. When the overseas market look more attractive, the corporates shift their borrowing overseas, and when the overseas yields or interest rates go higher, the view on rupee is negative. Then the borrowings all shift into the local market. So I think local market domestic banks still have very large amounts of liquidity, and I don't see any challenge that even if this borrowing gets shifted to local market, will have any problem for the banking system in India.
Unnati, you're on mute.
Right, so that's very insightful. My next question to you is, with the current rate hikes, how will the government manage to maintain the PPF rates and the other retirement accounts? How will they manage these interest rates as PPF is a very social sensitive subject in India?
So I think the tinkering on the small saving rates, PPFs or other small saving rates, has been far less. If you see, when yields were going down, uh, the government did not uh, bring down these rates as much as the GSEC yields had come down. Now on the way up, I think they will be a lag. So it's not as if as yields go higher, immediately we'll find the PPF and small savings rates going higher. I think they will take their own sweet time, and if they find that collections on small savings are significantly getting affected, and the government is unable to get the targeted amount of small savings collection, I think only then they will, increase the yields or rates on them. So I think there will always be a lag, uh, you know, after which they will decide to start tinkering around with those rates.
Right, sir. That is it from our end, sir. That was a very informative session. And on behalf of Cedrus Wealth Partners, I would like to thank you, sir, for making the time to grace this event, and to HDFC EMC, and to all our viewers for tuning in large numbers and making this event a success. We will return next month with a new topic and a new speaker. Until then, stay healthy, stay safe, and happy investing.
Thank you,
Thank you.
Shobit.
Thank
Thank
you,
you.
Nilesh. Thank you, Nati.
Thank
Thank
you.
you.
Thank you, sir.